Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Tuesday everybody. Just a quick piece of housekeeping at the beginning of today's episode. Today's video will contain sponsored content. I limit sponsored features to between 1 and a maximum of 3 per month. These are typically longer features, and this is to ensure two things: that the channel is financially sustainable, but that it is still primarily supported by subscribers rather than sponsored content. And 2, I think 1 to 3 longer form sponsored features reduces the interference with the viewing experience as much as possible. The sponsored feature will be labeled throughout, and for those who want to know what my policy is towards working with a sponsor, this is written in the description below. Okay, now with all that said, let's jump in. First up, we discuss the accelerating trends of US-China decoupling, especially in trade. According to new data from the US Census Bureau, Mexico outpaced China in 2023 in terms of total value of goods shipped to the United States, dethroning the Chinese after 17 years of dominance in imports. Total US imports from China last year reached $427.2 billion, falling by 20.3% compared with 2022, and slightly higher than the $421.1 billion from Canada in 2023. Meanwhile, the US brought $475.6 billion worth of goods from Mexico in 2023, increasing by 4.6% year-on-year. However, the US financial media outlet The Wall Street Journal writes that there is more complexity to this trend than the data would suggest at face value. The shrinking trade deficit overstates how much the US has reduced its consumption of Chinese-made products, argues the outlet. As the trade war heated up, many manufacturers began moving production to other countries to avoid US tariffs. So the US trade deficit with Mexico leapt to $152 billion last year, more than double the 2017 figure. The deficit with Vietnam ran at $105 billion last year, almost triple the level of 2017. Furthermore, the outlet continues, Chinese companies have been exploiting a decades-old provision in US trade law that allows packages worth less than $800 to enter the US duty-free. These are all the small little products that US consumers can buy online and are sent from China. Quote, federal data compiled by Yale University economists show the number of packages entering the US under that trade rule exception has tripled since 2017 to $1 billion last year. End quote. So it is a complex picture. Nevertheless, direct trade decoupling does appear underway across the US alliance system, especially in sensitive regions. For example, Japan-based financial media outlet Nikkei Asia writes that Japan and South Korea are also scaling back trade reliance on China. It reports, citing respective data, that the US became the largest destination for Japanese exports last year for the first time in 4 years, overtaking the People's Republic of China. Monthly South Korean exports to the US also outpaced those to China in December for the first time in 20 years. UK-based Reuters reports recently too that the United States is set to overtake China as Germany's most important trade partner by 2025, at the latest, if current trends continue, according to the head of foreign trade at the German Chamber of Industry and Commerce. The chamber reportedly told the outlet, quote, at the moment there is no signs of a significant increase in demand for products made in Germany from China. End quote. Deliveries to China fell almost 9% to roughly 97 billion euros, with cars and chemical products particularly down, while imports fell by almost a fifth to just under 156 billion euros. Next up, according to new Hong Kong Monetary Authority statistics, negative equity levels in Hong Kong surged to a 2-decade high, with the value of so-called underwater mortgages jumping to just over 131 billion Hong Kong dollars, 17 billion US dollars, as of the end of December, up from 60 billion Hong Kong dollars in September, and the highest levels since 2003. The number of such loans more than doubled to 25,000 cases in December from 3 months earlier. A mortgage falls into negative equity or goes underwater when the outstanding loan exceeds the current market value of the mortgage property. Now, negative equity loans account for about 7.1% of the outstanding value of all mortgage loans. US financial media outlet Bloomberg, writing on the development, explains that though property markets around the world are experiencing falling home prices and higher borrowing costs, Hong Kong is facing additional problems because of its reliance on a slumping China. Civils plc recently predicted residential properties in the Asian financial hub will fall more than 10% this year, the worst performer among 30 global cities it monitors. Quote, Hong Kong's property downturn has been triggered by high borrowing costs, macroeconomic concerns, and a population decline. Last year, the market posted the fewest number of transactions in 33 years, and the prices of its homes dropped to the lowest since 2017. While the government has introduced measures to boost transactions, analysts forecast home prices will stay flat or fall further this year. End quote. Bloomberg intelligence analysts Francis Chan and Patrick Wong believe that the rise in the number of underwater mortgages means lenders will struggle with losses and foreclosures. And of course, it puts tremendous systemic pressure on the housing and wider financial system. Okay, we are now moving into sponsored content. The world is going through historic shifts, affecting everything from geopolitics to global energy and commodity markets. For 3 decades, the US was secure in place as leader of the liberal Western world order. In this environment, the US allowed itself to outsource mining and manufacturing to a large degree around the world. But now, as there are signs of global order fragmentation in a post-COVID and Ukraine war world, Washington and other industrialized capitals around the world recognize the importance of bringing critical supply chains and mining operations back home. This is the case with lithium, this is the case with uranium, and it is particularly the case with nickel. Currently, the US only has one active nickel mine, and it is low grade. Before the electric vehicle revolution, nickel was primarily used as a coating for stainless steel in kitchen sinks. Today, however, it is the most crucial component of the batteries that power EVs. 29 kgs are needed in each one, compared with just 6 kgs of lithium. Elon Musk has said that he believes nickel shortages are now an acute issue. In 2021, he tweeted, quote, "Nickel is our biggest concern for scaling lithium-ion cell production." End quote. Then in 2023, he called for more mining of nickel. All of this is conspiring to create explosive demand for nickel mined in North America. Big players are seeing the trend already. Recently, Samsung, Anglo American, and Agnico Eagle have all made large investments into nickel mining in Canada. We could be on the eve of a big investment rush into this area. That's where today's video sponsor, Alaska Energy Metals, provides an excellent opportunity for savvy investors looking to take advantage of these historic shifts. There are 4 things that are exciting that should make you look into this company. First, it now has huge numbers of recognized resources. Just this month, the company released its independent mineral resource estimate and 43-101 technical report. Based on historical drilling, the report has been able to document over 1.5 billion pounds of nickel in an inferred resource. Second, now that there are inferred resources, the price paid for the property of this mine was a steal. The previous owner spent $30 million on drilling and other exploration efforts to define the nickel in the ground back in the 90s when nickel prices were low. Then the land package was spotted and purchased by Alaska Energy Metals veteran team for only $1.4 million. Third, there's a private company, Cobalt Metals, with some pretty heavy hitter investors like Jeff Bezos, Richard Branson, Ray Dalio, and others, which uses the most cutting-edge AI to find nickel, and their algorithm thinks that exactly where Alaska Energy Metals property is lies a prospective nickel mineralization. So they brought a massive piece of land right next to them. Fourth, the market could be currently heavily undervaluing Alaska Energy Metals. The current market price of the company is only $15 million. But if the nickel mining efforts end up being successful, company peers are being traded at between $100 million and $500 million market caps. The company is actively working on defining the resource, which means that the biggest single catalyst for shareholder value creation could be imminent. This is a speculative opportunity of sorts. Some risk, but also the potential for high rewards. Alaska Energy Metals can make an excellent addition to any well-diversified portfolio seeking to take advantage of the historic shifts we are seeing in energy and commodity markets. We remember that all investment involves risk. This is not individual investment advice. Always speak to an investment professional before making any investment decision. A big thank you to Alaska Energy Metals for sponsoring this episode of China Update. Okay, now we move back into regular coverage. I know that was quite a long feature, but like I said at the beginning of the episode, by reducing these to just 1 or 2 a month, I find that this is much less invasive than having, for example, a few shorter sponsored features per week. Okay, next up and finally for today, this week we will see the release of the latest book by outspoken and respected academic on Chinese governance, Minxin Pei. The book is called The Sentinel State, Surveillance and the Survival of Dictatorship in China. The book is about, quote, the CCP's Leninist bureaucratic structure, whereby officials and party activists penetrate every sector of society and the economy, from universities and village communities to delivery companies, telecommunications firms, and Tibetan monasteries, ensures that Beijing's eyes and ears are truly everywhere. While today's system is far more robust than it was in the past years, it is modelled after mass surveillance implemented under Mao Zedong and Chinese emperors centuries ago. End quote. US outlet Foreign Affairs has published an adapted excerpt of this book. We end today's video by examining some of it here. It's a long piece, but it is worth unpacking. Pei's work is often very robust and thought-provoking. We now quote parts of the Foreign Affairs piece on the book directly. Beijing's surveillance state is not only a technological feat, it also relies on a highly labor-intensive organization. Over the past 8 decades, the CCP has constructed a vast network of millions of informers and spies, whose often unpaid work has been critical to the regime's survival. It is these men and women, more than cameras or artificial intelligence, that have allowed Beijing to suppress dissent. Without a network of this size, the system could not function. This means that, despite the party's best efforts, the Chinese security apparatus is impossible to export. Funding constraints have long limited the CCP's ability to maintain a large domestic security force, let alone an elite, well-paid and well-equipped secret police network. A comparison with the East German Stasi is instructive. Before the fall of the Berlin Wall in 1989, the Stasi was the largest secret police force in the world in relative terms, with 1 officer for every 165 East German citizens. Additionally, the Stasi had 189,000 informants, roughly 1.1% of the population. The number of China's political security protection officials responsible for domestic surveillance is classified, but data I collected from a small number of localities, which was likely disclosed by mistake, suggests that there are only 60,000 to 100,000 of them, meaning that there is at most 1 officer for every 14,000 or so Chinese citizens. As a consequence, the CCP must rely on its organizational presence in state-affiliated social and economic institutions, as well as local communities, to recruit a large number of informants. These citizens can spy on their colleagues or neighbors, and because their participation is secured by coercion or enticement, it does not cost much to maintain them. Data disclosed by 30 local governments show that between 0.73% and 1.1% of China's population, perhaps as many as 15 million people, serve as informants. On top of that number, the regular police and secret police maintain separate networks of remunerated spies and unpaid informants whose exact numbers are classified. Another effective surveillance tactic is intimidating and monitoring people, the CCP classified as key individuals, or KIs. Advanced technology has significantly improved the state's ability to track blacklisted individuals. The MPS maintains a digitized national database of KIs to which local police authorities have access, meaning that these people are tracked both physically and electronically. When a KI travels, a system that captures mobile phone information can trigger automatic alerts. The online activities of individuals labeled Internet KIs are closely monitored by China's cyber police, again thanks to advanced but undisclosed technical means. Okay, that ends the direct quote and today's episode of China Update. Thank you so much everybody for watching. Have a great Tuesday, have a wonderful week. There will be no China Update tomorrow or on Thursday, so I will see you all, hopefully well rested, on Friday.